You wake up and check your bank app out of habit. The number didn't change overnight, but its power did. Your income is suddenly uncertain. Prices are higher than last month. The market is bleeding again. Debt payments are still scheduled like nothing happened. And deep down, you feel it. If one more thing breaks, you're not cushioned. You're exposed. That's how crashes actually work. Not with a single headline, with pressure. Slow at first, then everywhere at once. The next crash isn't a future event. It's a condition, and most people are already inside it. When systems fail, assets don't all die equally. Some evaporate, some freeze. A few get stronger under stress. The difference between the people who get wiped out and the ones who come out ahead isn't intelligence. It's positioning. I learned that watching smart, educated people make one fatal mistake. They owned things that only worked in good times. Let me show you what survives when everything else stops working. The first thing that stays alive is mobility. When markets seize up, when banks delay transfers, when selling means locking in permanent damage, the person who can still move has leverage. Liquidity isn't about returns. It's about timing. Cash gets trashed online because inflation eats it slowly. Forced selling eats you instantly. The people who make money in crashes aren't the ones fully invested at the peak. They're the ones who still have dry powder when others are desperate. Cash isn't wealth. It's optionality. Misuse it, and inflation kills you. Use it correctly, and it saves you. The second survivor is income that doesn't require permission. Layoffs don't care about your performance reviews. Companies cut to survive. That means your paycheck is a risk asset, whether you like it or not. The people who endure downturns aren't always wealthy. They're adaptable. They can turn skill into cash without asking anyone. Sales skills, technical skills, communication, repair, problem solving. These don't collapse when markets do. Demand shifts, but it never disappears. If your income comes from a single fragile source, you're leveraged in the worst way. Then there's cost structure. This one ruins more lives than bad investing ever will. When income drops, expenses don't negotiate. Mortgages sized for optimism. Cars financed on faith. Subscriptions that bleed quietly. High fixed costs turn a temporary downturn into a permanent setback. Lowering burn rate isn't failure. It's strategic retreat. The less money you need to survive, the longer you can wait, think, and act rationally. Time is the real currency in a crash. Next comes assets with real utility. Not stories, not hype, utility. Something that produces value, even when sentiment collapses. During crashes, prices lie to you. Cash flow doesn't. If an asset can't sustain itself under pressure, it becomes a liability fast. Appreciation fantasies die quickly when payments are due. Assets that feed themselves, conservatively, don't care what Twitter thinks. Another thing that survives longer than money is access. Networks don't show up on balance sheets, but they decide outcomes in stress. When fear rises, information fragments. Opportunity hides. The people who survive aren't always the smartest. They're the most connected. They hear about work first, deals first, capital first. Isolation is expensive. Relationships compound quietly for years, then explode in value when chaos hits. There's also positioning. This is where ego gets people killed financially. You don't need to predict the future. You need to avoid catastrophic error, small downside, large upside, flexibility over conviction. People who try to call the bottom usually call bankruptcy instead. The survivors structure bets that can't wipe them out, but can change their trajectory if they work. Asymmetry beats confidence every time. And then there's the asset nobody wants to admit matters most: discipline. Not motivation, not inspiration. Discipline. Crashes don't just destroy portfolios, they expose behavior, panic selling, impulse buying, lifestyle denial. People don't lose wealth because they're unlucky. They lose it because fear hijacks their decision-making at the worst possible moment. Discipline keeps you solvent long enough for strategy to matter. Without it, every other asset fails. Here's the consequence nobody warns you about. If you get this wrong, you don't just lose money, you lose years, maybe decades. You miss the reset. You spend the next cycle digging out while others build leverage. Opportunity cost compounds silently, and you don't notice until it's too late. But if you understand this, the crash changes shape. It stops being a threat and becomes a filter. Weak structures collapse. Strong positioning concentrates power. This is how wealth actually transfers, not at market tops, but at moments of maximum discomfort. The system doesn't reward optimism. It rewards preparation. So here's what you do, starting now. You audit fragility. Where would you be forced to sell? How long could you survive with reduced income? What expenses lock you into panic? Which skills follow you anywhere, and which depend on a single employer? Which assets demand feeding and which feed you? You don't need to be fearless. You need to be deliberate. Because the next crash isn't coming later. It's unfolding around you right now. And the people who walk out stronger won't be louder, richer, or luckier. They'll be the ones who prepared while everyone else pretended nothing was wrong.